Nobody wants to admit this, but Dubai's real estate market is very hyped. That being said, it doesn't have to be bad. Those who invested before COVID experienced the better part of the market hype that followed. And while in some other markets this cycle might have peaked, Dubai is very interesting and a pretty new phenomenon. So what if I told you that the headlines shouting that Dubai market crash will happen in 2026 are missing half of the story? Yes, there are red flags, especially in some certain segments. But after digging deep into the numbers, I'm pretty much convinced we're not heading for a crash. What's far more likely and meaningful for investors is a market correction perhaps and a cycle reset. In this video, I'm putting the hype aside and walking you through the data. Supply versus demand, historical cycles, which areas are more vulnerable and where the opportunity lies. If you want to invest smart, especially in off-plans, you need this reality check before making any move. With that being said, hit the thumbs up button, subscribe for more videos like this, and let's get into the video. Let's start with the basics. What is the market actually doing? There's record-breaking transaction activity. According to Property Finder's Q2 2025 market report, Dubai recorded over 53,000 transactions in Q2 2025 alone, a 22% increase year on year. Total transaction value, 184.3 billion dirhams, the highest quarter ever recorded. Demand, as you can see, it's not really slowing down. If anything, it's accelerating. But here's where concerns start. Based on Allsop and Allsop's Housing Supply 2025 report, developers launched 152,400 units in 2025 year to date, but only 21 to 22% of them have actually been completed. This means that the pipeline is actually ballooning and not really the supply. Reuters' real estate market outlook from May 2025 goes even further. They forecasted up to 210,000 units to be delivered in between 2025 and 2026, which is more than double of the historic averages, the highest construction cycle since pre-2009. Demand is high, supply is extremely high, and that combination is exactly why people are shouting market crash. But the reality is more nuanced. Almost all the scary headlines come from one number, and that is 87,000 units to be delivered in 2025. But that number is quite misleading. A lot of these aren't investor-grade homes. A major portion of these units include hotel apartments, branded serviced units, commercial buildings, and staff housing. Also, partial handovers and phased developments. This means the pressure isn't city-wise, but segment-specific. Oversupply risk is concentrated in high-density, off-plan apartment clusters, not villas or established communities. The National reported in November 2025 even something more interesting. Dubai needs 150 new homes per day to support the population growth. But on the real numbers, only 44,000 units will be completed in 2025. So yes, supply is rising, but demand is structurally strong as well. Oversupply doesn't necessarily mean crash. It could mean some selective pressure. This is the key point people miss. Not all Dubai's segments are equally exposed. Some areas I think will correct more aggressively than the others. According to DXB Interact's absorption data on off-plans in 2025, certain clusters show heavy search volumes such as in JBC, slow resale demand, and weak rental absorption. These include zones where developers flooded the market with small units, very identical layouts, and these are most likely to be the ones who will correct. Communities far from infrastructure as well. Value Strat's Q3 2025 index shows higher vacancy, slower rental growth, and weaker resale in communities still waiting for road access, metro connectivity, retails, and schools. Ultra-luxury and branded residences could face this as well. Khaleej Times' luxury market outlook in 2025 showed signs of inventory buildup, lower absorptions, and longer days on the market. This segment boomed aggressively, and those kind of booms always cool down. And finally, overpriced off-plans versus the ready units nearby. Many of the off-plans launched in 2024 and 2025 are actually selling much higher than the ready units units that were recently delivered. It's not even comparing to the ready units that were delivered many years ago. It's just new handovers with the new launches. So basically, this really proves that the stock is not really as limited, and the disconnect is unsustainable. A correction here is not only likely, it would be healthy. Now let's talk about where the real opportunities are. First, ready apartments in established communities. ValueStrat and CBRE both highlight strong rental demand in Dubai Marina, JLT, some areas of JVC as well, downtown, and Business Bay. These areas offer predictable rental demand, mature infrastructure so that people can actually have access to ATMs, supermarkets, and so on, strong liquidity, and also stable service charges, even though they might be quite high in areas such as Business Bay, but at least they're stable. You know what to expect and how to predict your cash flow. Number two is the villas and townhouses. According to Allsop and Allsop's demand report, villa stock is actually not keeping pace with demand, meaning that the price floors remain strong. Developer-backed off-plans only when they are priced actually in line with ready or even below, because not all off-plans are bad actually, but overpriced payment plan driven off-plan launches will suffer. I personally want to see the off-plan prices normalize and give us, the investors, some incentive to actually put our money, hold it for a few years, and then see actual good returns. And finally, there are yield-focused investments. MEAR Q3 rental report shows consistent rental pressure and strong absorption in mid-income communities. If your goal is cash flow, then 2026 could pretty much be ideal. Now, what does the Dubai history tell us? We have to address the elephant in the room. Is 2026 going to be another 2009? Let's compare. Regulations are completely different today. According to Dubai government and RERA frameworks, escrow accounts are mandatory, payment schedules are construction linked, and developers must meet the financing requirements. Number two is that demand composition has also changed. The national 2025 reports highlight Dubai's buyers today include long-term buyers and residents, families and end users, salaried expatriates, and global entrepreneurs relocated and living in Dubai. Back in 2009, the demand was speculative. Not as many people wanted to actually relocate and move into their apartments in Dubai. Now, let's talk about the Fitch ratings for the 2025 outlook, which was a big highlight and very buzzing in this framework. They were the ones who first predicted a 10 to 15% correction, but not a crash. Population growth trajectory is stronger than ever. So besides Dubai adding new supply, new apartments, Dubai is also adding new residents. So no, 2026 is absolutely not a repeat of 2009. Because in 2009, there were not as many residents moving to Dubai, and at least definitely not at the same unmatched pace. After reviewing all major reports, CBRE, ValueStrat, Reuters, Property Finder, DLD official data, and the XB Interact, here's what I can conclude. Scenario 1, which is most likely to happen, is a mild correction. 5 to 15% price softening in certain clusters, not everywhere, just in certain clusters. Rental yields will definitely remain stable just because there are so many residents coming in and they will actually need a place to stay in. And finally, the off-plan premiums will compress slightly. Or I might be biased because I want this to happen, but I think this should be and will be a healthy strategy. Next scenarios will be on probabilities, so we'll start with the higher probability, which is still below the one that I mentioned, but this is scenario number 2, which consists of flat growth and stabilization. Ready stock, family communities, and mid-range apartments will stabilize. Probability medium-high, this is scenario number 3. Villa and townhouses will continue with this strength because low supply and high demand from the end users will keep the prices firm. And the last scenario, which has the lowest probability, is of course the full crash. No major analysis or source that I looked into, and also from my own analysis and evaluations, actually report this. So I think we should take this out of conversation. Now, what is my actual own real opinion is that the market needs a slight correction, and this will be good overall for the market because What I actually think is that the market needs a slight correction for presumably only the off-plans. Because corrections are not bad, they restore sanity. And in this case, if you're going to continue overpricing off-plans as much comparing to the ready units, then this is not really healthy. And I really want to invest more in the off-plan space, but there should be some incentive. Investors will get squeezed if the prices will continue to rise at this kind of pace, and they won't have any incentive whatsoever to lock that money and wait for the handovers. So in this case, a slight correction will bring the discipline, forces developers to compete, which ultimately is actually good for us, the investors and buyers and end users, because we'll see better quality, better layouts, and better options, increases the value for investors ultimately, and gives genuine opportunities to enter the market. I really hope off-plan becomes attractive again in all segments, not just in specific buildings like it is today, but it must be priced correctly. Here's the truth. Dubai is not likely going to crash. Dubai is going to rebalance. Some segments will perhaps fall, some will outperform, and investors who understand data, not hype, will win. If you invest in strong locations, reasonably priced units, stable ready stock, and healthy yield communities, then 2026 could be an amazing entry point. So don't fear the cycles, but instead understand them. And if you need advice breaking down your investment strategy, click the link in the description and book a one-on-one call with me. Thank you for watching, and I'll see you in the next one.